Welcome to Asset TV's ETF Show, live from the New York Stock Exchange. I'm Rishika Gupta, and I'm pleased to be joined today by Todd Sohn, Strategas Asset Management's ETF Strategist. So welcome, Todd.
It's great to be with you. Thanks for having me.
Well, first of all, I want to talk about some of your ETFs that Strategas has listed on the New York Stock Exchange and look at the macro and micro climate through that and what you're seeing in terms of flows. And then we're going to get into your mid-year outlook. So first off, we're going to talk about the Strategas Macro Thematic Opportunities ETF, so the ticker SAMT. Now, this is a basket of themes approach to investing. So it allows investors to diversify some of that risk from single-themed ETFs. So first, talk to us about some of the AI beneficiaries theme, because, of course, we've seen this big AI rally really driving the market forward.
Yeah, so and our goal with the Strategas Macro Thematic ETF, SAMT, was to diversify away from the single theme, right? Picking a theme, entering and exiting it is always challenging. And so we have a basket of themes, AI being one of the primary themes, because it's clearly part of the next productivity boom, right? And so we have stocks like NVIDIA in there, of course, and Microsoft and Alphabet. But the idea being that this is going to change how companies work, how the economy works. And so we think this is a very long-lasting theme. Of course, there are single thematic AI ETFs out there, but with SAMT, at least we're getting a little bit more diversified with what else is in the portfolio.
And what other themes are you seeing gain traction?
Yeah, so a new one we have is the industrial power renaissance, right? So think nuclear. Right. And also because AI requires so much data power, electricity, right? We're looking for these stocks that can handle the capacity, that have the data centers to build out, the infrastructure to build out, the power that's needed to handle both AI as well as the transition, perhaps to nuclear, more nuclear as, the EV story's kind of dried up a little bit. I think that nuclear's picking up a bit. We also look at cash flow aristocrats, right? And these are companies that can handle a higher rate, higher for longer backdrop, cash flow rich companies. That's been very popular among other ETFs. We also think that they can withstand any further economic deterioration, as there might be some cracks forming in the economy. So we feel very comfortable with how that fund is positioned.
And next up, I want to focus on your Strategas Macro Momentum ETF, so the ticker SAGP. Now, you say this captures changes in market leadership and momentum within the early stages. So what are you seeing when it comes to that leadership and momentum? Of course, we keep seeing stocks notching new record highs and tech really driving that. So as per the flows, are you seeing any rotation to defensive assets at all?
So this is our most tactical offering, and we want to get ahead of leadership changes. We want to be able to capture any emerging themes within the market. And so that fund has been very much positioned towards tech strength. Flows have been all in on tech at the sector level, and it's been the right call. We're a little bit worried that maybe things are getting a little off sides. But if we have the ability in that fund to go more defensive, let's just say the market starts to correct here as the election comes into view. There's going to be volatility, I would guess. We have the ability to get more defensive, whether it's via utilities, whether it's via staples, or even just going to Treasury bill ETFs, or even something like gold. Gold has actually held up pretty well in this environment. And so we feel very excited about this new fund because of how dynamic it can be within the ETF wrapper.
And you mentioned the election and the uncertainty around that. So that brings me to the Strategas Global Policy Opportunities ETF, so SAGP. So tell me more about this form of factor investing. And, you said it's about firms lobbying in Washington. Can you give us a little bit more explanation on that?
Yeah, so this is run by our Washington policy team with Dan Clifton and Courtney Gelman. And when you think about factors, there's momentum, there's value, quality, size. We think that lobby, what Dan and his team have really drilled down into, lobbying is an undiscovered factor that's out there. And what they do is they'll screen, they'll look through all the filings of companies and how much they're spending in Washington, right? And so it's going to be a lot of healthcare companies who might be lobbying for a drug approval, or a lot of defense companies who need those contracts to build missiles or whatever systems we need here in America. And we think there's a lot of potential to exploit this idea of factors as opposed to going the more traditional route that we were just talking about here. So I think if you're looking for a different sleeve in your factor profile, lobbying is really one to consider with this fund.
And we've seen a lot of the political headlines, of course, being quite volatile. So is there anything that you're seeing in terms of flows, and what are that's telling us?
So it was a robust first half, right? Performance. You had equity flows put up their second best first half in history, only behind the 2021 euphoric environment. I'm a little worried that maybe we'll get a summer speed bump, and that may slow down the pace of equity ETF flows. Again, everything's been all in on tech. And if you're looking to diversify away, many of the other sector ETFs out there, including, say, healthcare, energy, materials, they've had outflows over the last year. And so to us, positioning at that sector level away from technology is really a place to focus on because not many investors are there. And so if you're just looking for something away from mega cap growth and maybe perhaps a change of leadership into the election, that's where we would start to focus on.
And I want to move on to your ETF outlook for the rest of the year. And I mean, you did just touch upon what I was going to ask you about. We've seen tech driving a lot of that and where we can focus outside of that perhaps in the second half and whether you see that momentum continuing.
So the Mag 7 is what it's been all about, right? We have three stocks, Microsoft, Apple, and NVIDIA, that are each 7% of the S&P 500. That's never happened before, at least in the 45 years of data that I have. And so I am worried about the growing ownership and concentration that many of these passive ETFs may have, right? It's not a problem until it becomes a problem. That being said, it's a great time to look at your portfolio and say, okay, do I have enough fixed income? 5% yields are great. There's many alternatives out there. Can I start to move out on the curve away from cash-like vehicles and maybe into the 7 to 10-year range of bond ETFs? Potentially as rate cuts start to grow, that's another option out there. But I think you're going to have this continued boom of active managers continue to embrace the ETF wrapper. You had $120 billion in active ETFs in the first half. That's phenomenal. And it's only a small clip of the industry, but it feels like things are just getting started in terms of the growth of the ETFs away from passive, which is fantastic, I think, for the overall industry.
And you mentioned the actively managed funds. Build upon that. They've had a lot of success. You see that continuing, and for what kind of a trajectory here? Absolutely
continuing. And so you think about active now. I think in the traditional sense, it was always the star manager, the alpha capture stock selection. Now you have synthetic income, right, using covered calls. That's extremely popular. You have option overlays, right, to buffer your protection on the S&P 500 or any other index. You have spread and duration management in the fixed income space, and even actively managed commodity type products coming out. And so there are so many managers out there who have products, whether it's in an SMA or a mutual fund, who now can address this in an ETF wrapper. And so active is going to move beyond just the star manager into all sorts of shapes and sizes, all different types of solutions, especially considering this new type of concentrated environment that the U.S. market has entered with those 3 to 5 stocks entering about 20% of the index. So absolutely major growth rate. There's a ton of opportunity there. And whether mutual funds are the ones that see the outflows or not, there's still plenty of runway for the ETFs to pick up the pace.
And Todd, finally, I mean, we've had the best first half for equity ETF inflows, and that's since the 2021 euphoria. So what kind of risks do you see on the horizon there? I mean, you mentioned tech and maybe there being a bit more, positioning there that might be overextended, but talk to us more about some of the risks you see going forward.
To me, it's all about what does the equal weight S&P 500 do going forward, right? So I get more worried when I see the cap weight S&P 500 carried by those 10 stocks or so continuing to rise while the average stock, the energy, financials, materials, start to decline. That hasn't happened just yet, but if I'm looking to gauge market conditions into the back half of the year, look at the equal weight S&P 500, look at the Russell 2000 small caps, that'll give me a greater sense of how much are investors skewing towards those largest names as opposed to the average stock. That creates a durability issue for the overall market. We're not there yet, but I would just at least put it on investors' radars for the second half.
Well, on that note, we'll leave it there. Thank you so much, Todd. That was Todd Sohn of Strategas Asset Management.